In 2023, I was looking at over a 50% loss in the largest position in my investment portfolio. So in this video, I'm going to show you how to invest correctly so that you can avoid the same mistakes that I did. I'm Santiago. I'm a private market investment analyst. I've analyzed hundreds of deals, including investments for high net worth clients. And this channel is dedicated towards sound investment philosophy and alternative investments. So let's hop right into it. You're probably wondering, what does this weird little drawing mean? And this drawing is going to help us understand how we can invest properly and the right way to maximize our portfolio. So starting with first things first, every investor, every portfolio, it all starts with our capital. And this is going to be inside our little cloud here. And our capital is going to be our income, our business, anything. And it's going to rain little money raindrops down that fall down into our soil here. And this capital and this rain, it's our environment. It starts with our environment, and our environment is controlled by our mindset. And one of my goals during this video today is going to be to open up your mindset and begin to shift those wheels to introduce you to a new mindset of investing that's going to help propel your portfolio and invest properly so that you can succeed in any market environment. In any type of environment, you're going to be able to succeed using this method here. And so when we invest and we have our little raindrops that fall down here, it goes into our soil. And what is our soil? Our soil is going to be our returns. And what I was doing before, and the trap I fell into, is going to be our little symbol right here called B. And this B stands for beta. So what is beta? Beta is just simply the market movement in returns. If the market goes up or your investment goes up, you're doing really good. You're really happy. If the market goes down, not so much. In my case, my investment in Alibaba was the stock had went terribly down. Not only did it go down from the period that I was invested 50%, but you also have to account for the time I spent in this investment that I otherwise could have been invested in the broad-based index or something else. So what I began to do as I became a private market analyst and study more, I've mentioned this many times on my other videos, is I began to focus on Greek letter P, was called ROW. I began to focus on ROW. What is ROW? ROW is the diversification and assets. And let me shift your mindset around this a bit here. So if we invest capital throughout our lifetime, we don't know what's going to happen. Anything can happen. There's an infinite number of possibilities. In my case and situation, I had a 50% loss on my hands, so that wasn't a really good outcome. But when the rain falls from our money and we put it in the soil, what are these little tubes right here? These little tubes represent diversification in the number of possibilities. The more different possibilities that we have, and the more access we can get the rainwater to our seeds at the bottom, the more possible outcomes we have. Most people think that they're diversified when they have different stocks. This is what I thought. Hey, I'm going to invest in the broad-based index, but then I'm going to pick some companies that I think can be successful. But in the end, if we're only using the stock market as an asset class, we are only using beta in our portfolio, which means no matter what we think, no matter if the company is undervalued, overvalued, it is still susceptible to overall broad-based movements. Sometimes the market just goes down because it goes down. In my instance, when I was staring at the 50% loss in Alibaba, China as a whole was just down. Didn't matter how the company was doing. It didn't matter what the balance sheet said. It didn't matter how much their revenue was growing. I had done all this research, But because of B, my investment was down. Now you have one or two choices. You can wait it out and hope that it comes back, but now you have time working against you. Or you can just sell it and move on to something else. I decided to sell it and focus on P, ROW, diversification in asset classes. When we plant our money into the ground, our fertile soil here, and we're looking to grow returns, we want as many opportunities to be successful as possible. This might look like real estate. This pipe right here might be private equity. This pipe right here might be private credit. This pipe right here might be a hedge fund. This other pipe right here might be a commodity. I'm going to remove all guessing from it, and I'm going to plant as many seeds as possible. I'm going to let as much rain go into here to build me a big tree. When we focus on beta, we are solely dependent on the stock market. As the stock market goes, we go. And this is part of the problem as a financial advisor when we're speaking to our clients that our clients are going through, especially retirees. They're worried and saying, if I retire in a year and my portfolio goes down by 30%, what am I going to do? We know that history and math says that the stock market at some point will bounce back, but we don't know when that bounce back will be, and we don't know the velocity of that bounce back. So when we limit ourselves to only a single asset class, we're only focusing on one seed, and we have our little leaf here. We're going to be successful. We're going to get somewhere between 8 to 10% return. We're going to be okay. But what if we could build this big, beautiful tree right here and instead focus on our asset diversification? This is where our alternative investments come in. This is the biggest change. In the past, I was so focused only on the stock market and picking stocks and understanding companies that it really didn't matter how good I was at picking stocks. I picked some winners, I picked some losers. In the end, my entire portfolio was subjected to beta. There was nothing I could do about that. And so sometimes it worked really well. Sometimes it didn't work so well, but it was still the stock market. Some seeds are going to be really good and work extremely well. How do we know, though, how much to put where? This is where we're going to focus on our weak links. I'm going to draw a chain link. Serendipity says the chances are in your portfolio, whichever one of these is the weak link is going to break the chain and perform really good. It's kind of the way it works out. And so if you are really strong in the stock market, but you have a weak link in private equity, chances are private equity is going to perform really good, just the way the universe works. If your weak link is private credit, the way the universe works, chances are private credit is going to perform really well. So what I started focusing on is instead of focusing on the individual stocks, just one asset class and being really good at that, I started focusing on strengthening the links in my chain, building these up more. And how do I do that? Well, we have a formula called expectancy. What is expectancy? So simply put, what expectancy is our average win multiplied by our average win percentage. Excuse my sloppy handwriting. Then we're going to subtract that from our average loser multiplied by our average loss percent. What is this formula going to do for us? This expectancy formula is going to tell us how to size our investments. So when we are on a losing streak, if I make a streak of just bad investments, maybe I invested in a private equity investment, lost my shirt, it didn't work. In my case, I invested in Alibaba, didn't work too well. My average loser and my loss percentage is going to increase. Therefore, my expectancy formula is going to go down. This means that my follow-on investments, I'm going to invest less to preserve my capital so I don't run out of money. If I'm on a string of good investments, if I'm doing really good, I invested in a house, worked out really well, amazing investment. It then invested in a couple of stocks that worked out really good. Then that means my average win percentage is going to increase. So every investment, you should be assessing, how did it work out? Did it work out really well, kind of well, break even? And this formula is going to allow you to see how much you should invest in each respective investment. Now, this is more of an art rather than a science because some investments require more capital than others. As your portfolio grows, for example, if you have a $1 million portfolio, you're going to have different assets with different investment amounts, and you need to make a decision on how much you should put in each asset class. How much should you put given a certain amount of risk? Expectancy will answer that question for us. So let's recap. How do you invest properly and avoid big mistakes and big losses? First things first, we have our capital. We have our cloud. We have a business. We have a job. We have some form of income, some form of capital that we're looking to invest. And that rain is going to fall down into our soil that's going to produce some type of tree, some type of result. It's going to bear some type of fruit. That is our returns. We want these returns to be spread across as many seeds as possible because we don't know which seed is going to bear fruit. We don't know if it's going to be that stock. We don't know if it's going to be that real estate investment we made. We don't even know if it's going to be that crypto investment we made. So we want as many seeds as possible in a well-balanced, diversified portfolio. This switches our portfolio from focusing on beta, which is the movement in the market. We want to take our portfolio away from being only subjected to the movements of the stock market because we know that the stock market is irrational, it just randomly moves. And we want to switch that risk to row. We want to switch it to asset diversification risk. When we switch it to asset diversification, the first question is, how much should I invest in what asset classes? We have our different asset classes down here, our different forms of alternative investments, and we can use our expectancy formula to understand what is our average win when we get an investment correct, what is our average loss when we get an investment incorrect, and that's going to tell us our expectancy and how much we should invest. Now, if you found this information helpful and you want to learn more about alternative investments, make sure that you check out my video that's going to be linked above, The Beginner's Guide to Alternative Investments. Also, make sure you click the link in the description and subscribe to AltShift. AltShift is a weekly newsletter dedicated to all things alternative investments, where I share portfolio insights and tips each week on how to improve our game, analyzing investments, and understanding portfolio construction. Also, if you found this helpful, go ahead, subscribe, hit the like button to my page, share this with a friend, and until next time, thank you.